The IMF Climate Coin Revisited, 1/3. By Frank van Gansbeke. This is the first article in a series of 3. Preambule. In January 2021, I published an article on the urgency for an IMF climate stablecoin that would offer incentives to nations to decarbonize their economy within the context of the 2015 Paris Treaty. The solution I proposed needs an update. In the interim, the idea has become less maverick thanks to, among others, the building blocks offered by Diem, Facebook's stablecoin project, and Kim Robinson's sci-fi novel Ministry of the Future. In the novel, Robinson introduces a carbon coin, inspired by a conceptual framework designed by Delton Chen, founder of the Global Carbon Reward Initiative. Today, the need for an IMF climate stablecoin has become even more pressing. The articles will focus on the heightened rationale for an alternative monetary innovation as well as on detailed design features, coupled with a numerical backup. The articles will also impart practical implementation guidelines as well as include measures to contain inflationary misgivings concerning the construct. Introduction. We have entered the state of a planetary emergency. The last decade has seen the highest temperatures in 125,000 years, with the challenge of imminent climate migration becoming more tangible. The UN International Organization for Migration estimates that there could be as many as 1.5 billion environmental migrants in the next 30 years. The world urgently needs capital allocation to steer the global water and stable food supply. There is a global food crisis, currently putting 345 million people at famine risk. A recent pain point is Pakistan, where almost a third of the country is underwater, 33 million are being displaced and as much as 4/5 of its livestock have died. The virtue of water company privatization looks less worthy of business school case study review now, in the wake of water supplies shut off without prior notice, as was the case in southern England last month. Utah's Salt Lake is drying out. Mega drought and water diversion of tributaries towards industry and agriculture have reduced the lake's surface area to less than 1,000 square levels, a third of its 1980 size. The world, and Europe in particular, have been stunned for the third time in less than 70 years by the geopolitical dependency on fossil fuel. Suez Crisis in 1956, Yom Kippur War-triggered oil crisis in 1973 and now the Russian-Ukraine invasion. There has never been a more opportune moment to advance national security as part of the decarbonization rationale. Notwithstanding the unreliable fossil fuel dependency, governments still perpetuate global oil and gas industry's domination with $700 billion in annual subsidies, per the estimates from the International Energy Agency, IEA, and the Organization for Economic Cooperation and Development, OECD. This wrong-headed policy results in, among others, regional air travel costing a fraction of train travel, even though train travel is less energy-intensive and can rely more on cheaper, battery-supplied renewable energy. Urgent decoupling needs to take place between the gas and electricity infrastructure grids and markets, to tangibly split and realize the cheaper cost of renewable energy as compared to energy sourced from fossil fuels. Global, government, corporate and retail combined debt stands at $300 trillion, and the largest 4 central banks have extended their balance sheet total to almost $27 trillion. Notwithstanding the harsh realities of climate change, commercial banks have advanced more than $4.5 trillion in loans and underwritings to the fossil fuel industry since the signing of the 2015 Paris Treaty. Inflation, more restrictive monetary policy, and the gradual unwinding of the central bank's balance sheet will undoubtedly lead to credit defaults and restructuring negotiations. Such developments will foremost devastate the $55 trillion debt position in the developing and emerging world. The emerging debt crisis is already feeling further strain due to imminent hunger threat, accelerated onshoring of supply chain capacity and hampered international trade prospects, triggered by multiple geopolitical tensions and the imperative to reduce the fossil fuel footprint in international trade. Sri Lanka, Russia, and Zambia have already defaulted. There are more than 40 countries that have been identified as at risk, with credit spreads close to or more than 10%, 20 of which are in Africa. This is the end of the first article. The second article will be released soon. IMF Climate Coin Revisited, 2/3. By Frank van Gansbeke. Preamble. In January 2021, I published an article on the urgency for an IMF climate stablecoin that would offer incentives to nations to decarbonize their economy within the context of the 2015 Paris Treaty. The solution I proposed needs an update. This is the second article in a series of 3. You can find the first article here. Decisive decade. As part of the transition in this decisive decade, there is a need to rethink priorities and drastically reallocate capital, favoring clean energy, regenerative agriculture, water management infrastructure, and pollution-scarce initiatives on a large scale. There is an urgent need to incentivize and reward sustainable, healing, and innovative decarbonization efforts. The Paris 2015 Agreement must be integrated into our financial, economic, and industrial framework. The most vulnerable countries must be both a priority and be part and parcel of the comprehensive solution. What if a global circular capital and investment flow bolstering coin could be designed that would provide concurrently global pricing signals to carbon, land and forestry, sustainable managed companies and would de-risk climate technology? Additionally, the coin could be set up for both mitigation and adaptation purposes. In the case of mitigation, it would offer much-needed funds to vulnerable countries in exchange for tangible and measurable contributions to reducing greenhouse gas emissions within a Paris Treaty context. In the case of adaptation, the analog principles could be applied separately to set up a climate insurance fund, where vulnerable countries could claim compensation in case of being hit by climate calamities. Enter the IMF Climate Stablecoin. The IMF Climate Stablecoin explained in basic building blocks. What follows are the essential stepping stones to the design of the new monetary concept. Each of the IMF quota member countries would engage in a climate quantitative easing (QE) policy initiative at their central bank level. The procedure is similar in mode to the QE policies undertaken during the 2008 financial crisis and the COVID-19 pandemic. The generated funds at the central bank would then be transferred as contributions to the IMF. The IMF in turn would convert the contributions received in fiat currency into special drawing rights, SDRs. IMF manages special drawing rights, which are international reserve assets composed of US dollars, euros, Great Britain pounds, Japanese yen, and the renminbi, since 2016. The SDRs act as a unit of account and can't be used for payments by governments or individuals. Within the context of the 2015 Paris Treaty, the IMF would create a 2015 Paris Treaty subsidiary. The IMF would transfer SDRs, including those already on the IMF balance sheet, towards the subsidiary to provide the entity with capital. On the back of the SDRs, the subsidiary would issue the IMF Climate Stablecoin. The IMF Climate Stablecoin would be a unit of value, and to a lesser degree a store of value. The supply would be limited to a pre-identified carbon reserve. This reserve represents a certain carbon quota, which upon depletion would result in exceeding a temperature increase threshold. The coin would be designed per the guidelines of a stablecoin structure. A stablecoin is a type of currency whose value is tied to an external asset, such as a fiat currency, the US dollar, or commodities, gold, to stabilize the price. The IMF climate stablecoin would be linked to a combination of natural assets and investments in top-performing sustainably managed companies and venture capital climate technology. The coin value would be set at an equivalent of $1 per ton of Colorado 2 EQ abated. The price formation would be a function of global price levels at emissions trading schemes, ETS, but would most specifically exert an incentive function. At inception, the subsidiary would invest the SDRs in the following collateral components, in accordance with the following weights. 40% would be backed by investments in land and forestry, 40% by investments in the top global 1,000 listed, sustainably managed companies, 15% in climate technology venture capital along with a remaining cash reserve of 5% of SDRs. The coin would be recalibrated at regular intervals to both ensure the proper price signal for abating 1 ton of Colorado 2 EQ and to remain aligned with the valuation of the respective underlying collateral components. The IMF climate stablecoins would then be offered to, initially, the V20 countries, now representing the 45 poorest countries on Earth, within the context of the Paris 2015 Treaty. Each of the V20 countries could claim IMF climate stablecoins in exchange for tangible, third-party verified, and permanent progress in abating greenhouse gas emissions, expressed in tons of CO2 equivalent. The achievements should be in accordance with detail furnished in each country's nationally determined contributions, NDCs. These are individual nations' climate action plans to cut emissions and adapt to climate impacts required by the Paris Accord. V20 countries could obtain fiat currency, dollar, renminbi, euros, yen, by offering the Imf Climate Stablecoin in medium-term repo transactions. A repo transaction allows a counterparty to offer an instrument or a coin in collateral in exchange for cash, adjusted for a haircut applied on the underlying collateral value. The generated funds would then be used by the V20 countries to make proven clean and green technology acquisitions in the IMF quota member countries. These capital expenditures would scale and expand the V20 decarbonization ambitions to accelerate further progress on the goals of their NDCs. The program could eventually be expanded to all 2015 Paris Treaty signatories. IMF Climate Stablecoins benefits. The proposed structure would offer several benefits. The envisaged structure could be implemented within the current IMF mandate or with only slight modifications. The structure represents a fully global circular dynamic, whereby QE-originated funds are being recycled back to benefit green and clean energy industries fully aimed at decarbonization. The IMF Climate Stablecoin has two inflation-containing design features. First, the circular capital flows supporting capital investments would keep inflationary pressure in check. Secondly, the coin supply is limited to a predefined target level of the carbon reserve. This would be irrespective of neutralization measures, in the form of sale of central bank balance sheets assets, which could be undertaken by the respective institutions. The IMF Climate Stablecoin is a reward for reducing greenhouse gas emissions. The climate coin would impart an indicative global price level for carbon, identified as 1 ton of greenhouse gas emissions. The IMF Climate Stablecoin would, through its collateral components, convey strong price signals to the valuation of land and forestry, the valuation of sustainably managed companies, and would de-risk climate technology venture capital investment exposure. The IMF Climate Stablecoin coin would provide tangible support to the plight of the poorest countries, represented by the V20. The V20 member countries would be recipients of proceeds for protecting land and forests and would become destinations for establishment of moonshot projects. The same countries could also receive further Motley or IMF climate stablecoins for tangible progress in their climate mitigation efforts, as represented in their NDC commitments. The IMF climate stablecoin would also foster tracking of funds in a transparent manner and on a global scale, ensuring that the use of proceeds would be in full alignment with the NDC commitments. The coin could be named the Motley, referring to the visionary Barbados PM Mia Motley, who brought the issues confronting small island states, and by extension the Global South, to the world's attention. Those states are most at risk for heightened sea levels, yet they have contributed the least to the overall level of greenhouse gases. To worsen matters, their interest rate levels are punitive, not because of the hazard caused, but merely because of their geolocation. Numerical detail. There are 290 gigatons of greenhouse gas emissions left before exceeding the 1.5 degrees Celsius threshold. The objective is protect and extend that reserve for as long as possible. Assuming the carbon price for 1 ton of CO2 abated would be set at $100, then $1 trillion would protect or abate about 10 gigatons, or about 16% of the annual amount of greenhouse gases, 60 gigatons Colorado 2 EQ, emitted. So, on the back of those assumptions, a first envelope of $6 trillions equivalent in IMF stablecoins could be released. These magnitudes would have to be calibrated with the additional capital investment expenditure to yield net zero by 2050 in the rest of the world. IMF stablecoins in circulation. The IMF can maximally issue 60 billion IMF climate stablecoins if the carbon price per ton is held constant at $100. This would provide an envelope of $6 trillion, equivalency, in issuance capacity. If efforts need to be ramped up, then a IMF Climate Stablecoin 2 series can be launched under the same design principles, but still within the limits of the annual 60 gigatons Colorado 2 EQ. This the end of the second article. The third article will be released soon. Offer incentives to nations to decarbonize their economy within the The IMF Climate Coin Revisited, 3/3. By Frank van Gansbeke. Preamble. In January 2021, I published an article on the urgency for an IMF climate stablecoin that would offer incentives to nations to decarbonize their economy within the context of the 2015 Paris Treaty. The solution I proposed needs an update. This is the third and last article in the series. You can find the first and second article here. So far, I explained the rationale and the building blocks of the IMF climate stablecoin. This article will focus on the collateral management requirements as well as the several ancillary benefits the IMF climate stablecoin could offer. IMF stablecoin collateral management. The IMF would appoint collateral pool managers with an extensive track record in the respective asset classes. The team would gradually convert the collateral pool into a solid reserve of sustainable assets, consisting of 5% in special drawing rights, SDRs, 40% in forests and lands, 40% in the top 1,000 most sustainably managed companies, and 15% in renewable energy and climate tech venture capital. The IMF would hold a custody account and a carbon registry account. The custody account would manage the allotted IMF climate stablecoins by country and the respective assets representing the overall collateral base. The carbon registry account would monitor, via satellite imagery, the specific geographic areas the countries have disclosed in their pursuit of their nationally determined contributions, NDCs. Land and forestry, 40%. The invested land and forests would represent significant carbon sinks, identified as tipping points by the Stockholm Resilience Center. For example, these carbon sinks could be parts of the Costa Rican, AV20 country, rainforest or the boreal, taiga, forests. The IMF would also manage a perennial carbon registry by parcel, land, forest, water surface, mangrove, etc., identified by submitted NDCs. The contributions could center around regeneration, soil regeneration, afforestation, etc., decarbonization, or all-out protection efforts, safeguarding rainforests, etc. The respective IMF climate stablecoin allocation would be only settled against unique and third-party certified proof of work. The land and forest would be managed in close collaboration with local indigenous people, who hold the most relevant stewardship knowledge. Sustainably managed corporations, 40%. The IMF collateral manager would endeavor to pursue investments in liquid shares and bonds issued by the top 1,000 sustainable or ESG-compliant companies in proportion to their market capitalization. A first selection could be drawn from the World Benchmarking Alliance of the most influential 2,000 companies, prominent in essential system transformation. The exposure would be built over time. Each exposure would never exceed more than 0.5% of the overall collateral basis. The portfolio companies would be stellar underwriters of do no harm intent and would not engage in any extraction activity. The individual equity stake in the companies could not be more than 10% of the capital stock. The identical threshold number would both apply for a liquid bond issue, of at least $1 billion issue size, and the overall company indebtedness. In general, the companies would display a nimble if not carbon-neutral footprint and seek to engage intensively with the circular economy initiatives. Furthermore, they would track at least 5 quantifiable impact key performance indicators, which are related to their environmental, social and governance footprint. Each of the companies would be exemplary in their sustainability disclosures as well as TCFD reporting returns. Their sustainably managed business model would be identified by numerous sustainability-oriented index rankings and ratings. Climate tech venture capital, 15%. The investment efforts would combine established clean energy players and early-stage venture capital, VC, type initiatives, potentially accelerating the decarbonization of electric and thermal, heating and cooling, energy procurement to the transport, green hydrogen, agriculture, regenerative practices, construction, green cement, and hard-to-abate industry sectors. Only co-investment opportunities would be pursued with established global VC or industrial players regarding VC-type investments. The investment experience of funds like Generation Investment Fund, with $40 billion assets under management, Stripe Climate and VC 2150 would be foundational for the IMF climate stablecoin. Moonshots. The IMF would also make investments in moonshots, of which some V20 countries will be beneficiary destinations. These moonshot investments, executed in collaboration with governments, academia, and VC experts, could take the form, for example, of a global water management office, a global stable food supply center, a global carbon footprint management bureau, a regenerative agricultural research lab, a green hydrogen development lab, a coastal defense technology expertise hub, or a CERN-type climate research center. Valuation of the stablecoin. The value of the IMF Climate Stablecoin would be set at dollar price per ton of CO2 abated. The price would have a signaling function for mitigating 1 ton of carbon and be set as a function of global emissions trading systems, ETS, prices. The underlying collateral pool would be gauged monthly to ensure compliance with the unit of account function and the notion of the stablecoin. The IMF Climate Stablecoin could evolve within a band of plus or 5%. An uptick beyond that threshold would trigger the sale of the most liquid assets. The proceeds would be moved into a stabilization fund, where the fund would also benefit from an amount of seed IMF assets. In the case of a 5% drop in the overall collateral value, proceeds would be retrieved from the stabilization fund. The stabilization fund would also modify the carbon price if conditions compel to incentivize signatory countries. In 2050, the proceeds of the overall sale of liquid investments in renewable energy initiatives, sustainably managed companies, and biotech research would be distributed to the countries in proportion to their climate coin holdings. Other application opportunities. The IMF Climate Stablecoin could become a reputable pricing benchmark for carbon, taking price guidance from mandatory compliance ETS carbon markets. The indicative price would act as a floor for global carbon trading. It could be increased as a function of the remaining carbon budget and compliance status of the individual countries' NDCs. The IMF Climate Coin could also be used if a country faced major foreign exchange market volatility. A nation faced with balance of payments problems resulting from curtailed export activity, triggered by a pandemic outbreak or climate change-driven shorter supply chains, could sell its allocated IMF climate coins to source hard currency. A broader, separate IMF climate fund could be structured for climate adaptation purposes managed alongside similar principles. The converted SDRs would be managed as an insurance fund in accordance with the same investment allocations as the IMF Climate Stablecoin. If a country, small island state or other V20 country were hit by a devastating climate calamity, it could seek immediate release of such funds. The defaulted creditor country could offer new security after applying an agreed haircut with the debtor parties, coupled with an additional warrant, linked and backed by their IMF climate coin's value in reserve. The restructuring would be endorsed only if there was a commitment to improving on the country's NDCs within the Paris Treaty. The size of the amassed IMF climate stablecoins could also contribute to improved sovereign sustainability ratings, as designed by rating firms and NGOs alike. A more favorable sustainable rating would lead to lower debt service payment and boost further efforts to maximize IMF climate stablecoin allocations. Foremost, the IMF climate stablecoin could become a standard or anchor against which fiat, cryptocurrencies, and central bank digital currencies could be benchmarked. The anchor currency would provide stable pricing guidance, backed by precious natural capital assets in a collateral pool and representing a finite coin supply to steward the essential reserve for sustainable survival on Earth. This is a monetary blueprint solution in its infancy. I invite observations and comments to improve on the current construct in the knowledge of Victor Hugo. Our mind is enriched by what we receive, our hearts by what we give.